All right. Well, once again, good morning, everyone. Thanks for being here today. Do appreciate it. Implied volatility is one of the most challenging things for folks to understand when it comes to trading. Now, there's two different kinds of volatility that most people are concerned about. The first one is going to be historical volatility. The second is going to be implied volatility. Now, historical volatility is relatively easy to understand. You just take a 1 year period of time, figure out the difference between the highs and the lows, and that tells you how much the stock, how much the stock has swung back and forth in that period of time. The implied volatility is much harder to understand, and most people end up feeling a little bit more like this. This is what implied volatility seems to be to them. I don't think you're going to be able to see the entire picture that I just put up here, but that's a little bit like what implied volatility is for most traders. It's just that thing that just keeps swinging it back and forth, spanking you all the time, because of the crazy wild gyrations of the market. So it's a little bit more like that. And a lot of people just absolutely hate volatility in the market. But if you talk to a lot of folks out there, they're going to tell you that they believe volatility is incredibly useful in the market. Day traders love volatility because it gives them more frequency of trade setups. Even Warren Buffett has a love for volatility, because when that volatility occurs as an investor, it oversells markets. It oversells stocks. Okay? Sound going in and out. You may want to try rebooting in the room. Everyone else's sound okay? Loud and clear. Some in and out. It could be an Omnovia issue. So you might try rebooting it into the room. Those kind of things. Click that red X, rebooting yourself into the room. So when you take a look at implied volatility, there's a lot of different opinions about, or volatility, what that really means for the market. Some folks really, really like that volatility. But for the most part, those of us with that swing trading style of trading, volatility can be pretty harsh and really difficult to navigate. And honestly, sometimes it's better to just set out that volatility. So let's take a look. Does anyone not know, anything about what volatility is, or implied volatility? Implied volatility is a calculation of how options are being traded. Okay? And that's one of the things that's difficult to get your head around. It's not a calculation of what's happened in the past. It's a calculation of what people are, or how traders are trading options and expecting that volatility to change in the future. Okay? So it's hard to get your head around that concept. We're actually trying to use the the trading of options as a crystal ball for what comes next in the market. Okay? And that crystal ball is cracked. It's hazy. It's full of fog like it is here today. It's very hard to see into the future of what's going to happen to these stocks. But implied volatility has a direct effect. Whoops, wrong tool there. Implied volatility has a direct effect on option prices. Okay? IV directly affects the extrinsic value of an option, or what they call the time value of an option. So when you're looking at an option chain, we have intrinsic value and extrinsic value. Okay, so just a little test. If we have a $10 stock, okay, the stock is priced at $10. You buy an option that's a 9-strike option. I can't spell. You buy a 9-strike option, you pay $2 for that option. Okay? $2 for that option. What is your intrinsic value? What is your extrinsic value? Yeah. 1 and 1, right? So you have an intrinsic value of 1. And to understand that, if this helped me a lot when I was trying to figure this out, your intrinsic value is how much the stock is in the money. Okay, so if you have a contract, remember the rights and obligations of option trades. If you have a contract at 9, it gives you the right to buy the stock at $9. You have the right to buy the stock at $9. The stock is selling for 10. The premium you pay is part of that intrinsic value, which is that $1. And the extrinsic value here is that $1. So if we look at that intrinsic and extrinsic, as $1 and $1. And implied volatility over here goes from 20% implied volatility to 50% implied volatility. What happens to the price of the option? Yes, but what part of the option goes up? See, the intrinsic value doesn't change. There's no change. Implied volatility has no change on the intrinsic value of an option. No effect whatsoever. So only the time value of that option goes up. So let's think about this as a swing trader. If there's no effect of implied volatility on the intrinsic value of your option, and the extrinsic value is rising, precipitously, it's really going up, is there more risk or less risk in this trade? Yeah, a lot more. All right? And why is it a lot more? Because intrinsic value doesn't fluctuate, but the time value of that option fluctuates, and this decays. Okay? So our time value decays. Our time period of this option is the same time period when it was at 20% or 30%. If this is a 30-day option, okay, a 30-day option, the risk of this trade dramatically increases because we end up paying more for time value. And that is a decaying asset that's going to rapidly decay toward expiration. Is that making sense? So we always have to think about implied volatility as that implied volatility is increasing the risk of the trade. Okay. Now, what if we what if we go to the opposite way? We talked about buying an option here. What if we sell an option? What if we sell? Whoops. Can't get the right tool. What if we sell an option? And implied volatility is high. We have a 50, 60% IV. Okay. This is something that really messes up a lot of traders. Okay, because what they're typically taught out there is when volatility is high, that's the time to be a premium seller. And while that's true, it also has some major ramifications that people don't think about. Implied volatility increases that premium that we can sell. It's a nice fat premium. High implied volatility, that extrinsic value, high probability of that extrinsic value eroding in our favor as a seller. Okay? But a 50% IV tells us that there's also more risk in this trade, that we can expect that stock to have bigger price swings. So by selling this implied volatility, is this a less risky trade or a more risky trade? Is there more risk in selling that? There's more risk. Okay. There's more risk. Now, the reason that occurs is in the calculation of implied volatility. They really factored in this idea that goes all the way back to commodities trading, and it's the cost of carry. Okay. So the cost of carry tells us that if we just imagine this, you buy 100,000 bushels of corn. Okay. You buy 100,000 bushels of corn. Is there a cost in holding that? A risk in holding that? So when they calculated out these prices, there's a cost or an expense, a risk of holding that product. Okay? So that cost of carry is being kind of factored in to the risk equation of that implied volatility. That implied volatility is saying, well, when the stock is bouncing up and down like crazy, there's higher risk of carrying this option. So anyone who sells one of these options, remember, as the seller of the option, you're the writer of the option. Always remember that. As the seller of the option, you write the option. You are the obligation. You are the obligated party to fulfill the terms of the contract. Okay? And so that implied volatility, if your obligation now becomes much riskier, you're going to require more premium, right? for your risk. Because of that cost of carry. There's more risk in holding that position because of the fluctuation of the market. That's why the premiums go up. All right? And a lot of folks don't understand that. They just hear that phrase out there over and over and over. Well, it's a volatility market where you want to be a seller of premium. Okay, but why? Why do we want to sell premium in a high volatility market when the stock is whipping back and forth? What we've just done, if we don't understand what we're doing, we've just taken a higher risk trade with a higher probability of losing. Does that make sense, guys? And I think this is really, really important because a lot of people, they don't cover this part of that high implied volatility. They don't cover the risk, how much risk has changed in that trade. They've given people the impression that when the volatility is high, you can just blindly go out there and sell premium. You're going to make money. That's what you want to do. But that's just not true. Okay? So, the question that Glenn's got, won't theta be more in your favor? Well, let's think about that. I did mention that already. If you have 30 days to an expiration on the option, and your 20% IV brings out a premium of an option at $3, and your 50% IV gives you a premium of $3.75. Do you have a greater rate of decay in 30 days? Yes. As long as you're right on timing and direction. Okay? As long as you're right on timing and direction. Yes, theta works in your favor because we have more extrinsic value in this option, because the intrinsic value of this option did not change because of the increasing implied volatility. Only the extrinsic part of that option increased in value. And that increase in value was because it is higher risk to take that trade. Okay? They have to do it. They have to raise that risk, or who's going to take the higher risk on a trade to be the writer of the contract? There'd be nobody selling contracts. The market stops. So they must increase the price of the option, the extrinsic value, to get those to sell. But most people don't understand. They get caught up in this up here. Oh my gosh, I'm going to get, make a lot of money and everything's going to be working in my favor. What Alan just posted down there is absolutely true. Higher IV means there's more risk of being called away or being put to stock. You've just taken a higher risk position. Interesting question, Judy. What I normally do, let's go to like Coca-Cola here. What I am normally looking at, and Thinkorswim makes this really easy, and most option places make this pretty easy, is you can look at the series, okay, all of the implied volatility numbers for each series. Okay? What I'm looking for is a normalized volatility. Okay? Where across the months, it stays pretty much the same. Now, if we have something that has relatively low implied volatility, we know that the extrinsic value that we're paying on that has lower is a lower value. Okay, so I have a little bit more. Well, I'm within a point or two here. Okay, take something like OSTK. What do you think of this implied volatility? So what that means is that stock has the possibility of moving 120 plus percent up or down from where it is. According to the way the options are being traded. It's highly volatile, and that means there's high extrinsic value in those options. Now, what you're going to find is if we go back and we look at Coke again, if we look at Coke, you're going to find, and the question is, what's high, what's low implied volatility? Well, when you look at an option series, and if all of a sudden we looked in here and this option series right here had jumped up to 30 IV, we would want to take a second look. What's happening here? Why is this option contract so out of whack? Yes, you get higher implied volatility around earnings. You get higher implied volatility around known news events that are happening. Rumors of mergers, rumors of stock splits, rumors of, virtually anything can change the implied volatility around that series. So you want to investigate that. When you look over here and you see something out of whack, you want to pay attention to that before you dive into that option. Okay? Only if the price action warrants the iron condor with the support, resistance, and trend, Greg. Not just because the implied volatility is high. You can have high implied volatility and have no setup for a trade, and you just stepped into the most common trap that option sellers step into. They blindly run into a trade because there's high implied volatility, and they get their head handed to them. Okay, so we have to have the trade, the pattern. That's right. News events, known things, court dates, all of those kind of things can have a major effect on the implied volatility of an option chain. Okay, now what you're typically going to find is if you look at a company like Coke, low volatility, those kind of things, what you're typically going to find is relatively tight bid-ask spreads. Now this isn't fair because during volatile markets, when the market closes, you guys have probably seen this a lot. When markets are volatile, the market makers spread out the bid-ask spread after the close. What they're doing is they're protecting themselves for the next open. Okay. Typically, you look at Coca-Cola and you're looking at 5, 10-cent spreads. Okay, pretty typical. But what they're doing is opening them up right now. Because of that implied volatility, market makers are protecting themselves in these trades. And so, have you guys noticed that in the mornings? Oftentimes, or have you ever been holding a position and your position is winning? The market closes and all of a sudden now your position is negative. If you trade enough, you'll see that. And what that is the market makers opening up the bid-ask spread at the close to protect themselves. Okay, they're protecting themselves from that next day's open because of the volatility of the market. So they spread them out, and then after 5 or 10 minutes after the market's been open, they start to normalize again, right? They start coming back together. And so all it is the market makers are responding to the implied volatility. But typically you're going to have relatively tight bid-ask spreads. As long as there's enough open interest, you'll have really tight bid-ask spreads. But you go to something like OSTK, you're going to see much wider bid-ask spreads typically. Because of the risk. The market makers aren't going to take all the risk on that high volatility trade. So they open up the bid-ask spread, make it more expensive for you to enter those trades. And you have greater risk to the theta decay. Okay. Most market makers are computerized now, yes. There's very little pit trading done anymore. The S&P, there's an S&P pit that trades. Commodities, a lot of the commodities are still open cry. But there's very little of the traditional pit traded position anymore. And so that makes them essentially computer operated. Okay. Now what happens in a trade after an unknown event becomes known? We've seen this before a lot. Okay, and here's where the good part of implied volatility can be beneficial to option sellers. If you have the timing right, if you're right on direction. It can also be the thing that hurts you badly if you're not right. So we get that event that occurs, and let's say that 20% implied volatility, normalized implied volatility, spikes up to 50%. Okay, the event occurs, the earnings event happens, and in a very quick move, that implied volatility collapses back to the normalized volatility. So as the option holder, if you hold an option during this time, if you're a buyer of that option during that period, you can be absolutely correct on the direction of the trade and still lose money. Because when you bought that option, you paid the higher implied volatility. You paid for that high extrinsic value. that immediately collapses back down. So that extrinsic value goes back to normal. You paid high premium for that extrinsic, and it collapses back. They call it the volatility crush. Okay? For the sellers, for the writers, if you write the option, okay, and you sell this premium here that's high, and it crushes back down, you make bucks, right? Nice bucks. So as a buyer, the implied volatility can really work against you on that volatility crush during news events. As the writer, it can work for you if you have the timing right and the direction right. If your direction, your timing and direction is wrong, what happens to you? Not only do you lose, but you lose big. Big percentage, because that implied volatility works massively against you if you've got your direction wrong. Okay, now let's take a look at implied volatility on just a normalized stock trade. If we're looking at, just a second here, this drawing tool, as great as it is, it makes me crazy sometimes because it changes things automatically. So if we're looking at a normal stock trade, and we're moving up, and then we get this nice long consolidation. Okay? In a standardized price move, if there's nothing out there that is, that we're expecting some news event, there's no earnings event, there's nothing like that. If we get a stock that goes into a period of consolidation, what happens to that implied volatility? That's right. Implied volatility will shrink a tiny amount. It doesn't really, I wouldn't really call it collapse, Bal, because it hasn't really spiked a ton. Okay, because this is just a normal stock move. Yeah, it lowers, it drops. The longer we stay in a little implied volatility or a consolidation like this, the cheaper and cheaper and cheaper those options become, because that implied volatility drops and we incrementally lower the price of that option. So here's one of those great ways that we can use implied volatility. If we find these trades like this and can catch that entry into this trade, what happens as soon as the stock starts to move? This lower implied volatility goes back to normal. It normalizes again. Yeah, that IV increases. It goes back to that normal range that it would normally be. That means in this move up, not only are you getting the intrinsic value moving up in your option, you're getting the extrinsic bump because of that change of implied volatility. Okay? And that's why anytime you're messing around volatility or using options, timing and direction are very important. Okay? Have you guys ever bought that trade that you just happen to catch it just right, and you're literally surprised at how fast that price went up? Just how fast that option made money? even on a relatively small move, that's that change of implied volatility really spiking those profits for you in that trade, okay? So finding that trade and concentrating on the timing of that entry is extremely important. We want to catch that trade as it starts to break. Yeah, pop out of the box up or down, either long calls or long puts are great out of those consolidations because we get that spike of implied volatility in that move, okay? And we get that opportunity then to experience both the intrinsic and extrinsic values increasing pretty rapidly for a short period of time. But remember, all it's doing is going back to normal, okay? All it's doing is going back to normal. Now, what if we get that stock that has that extremely volatile move? We're watching this stock. We're watching something. Maybe it's been trending, okay, and that stock has been moving up in that trend, doing what we like to see, and then all of a sudden something happens in this stock and it does this. Okay, we've been experiencing this lately, right? Now, as a swing trader, this is pretty difficult for us to deal with, just buying, how do you trade this? Okay, in the normal conventional thinking of trading a price move like this. This is where the selling of the options come into play in a proper way, okay? In a proper way. So we may look at the chart and say, wow, this thing dropped like a rock. 2, 3, 4 days just dropped like a rock because of some change. Something happened. Market got shaken up. Whatever it was that we just had this collapse, another tariff increase or something like that comes along and this occurs. Well, when that happens, that implied volatility spikes. So you may be in a 15 implied volatility option here, and then suddenly down here, this is up 60% implied volatility. Well, if we can look at the chart and find a relatively strong level of price support, meaning that there's price action in that trade, whether it be relatively near or some of the past price action, we're back in here, there's a good solid level of support. All of the price action last year, we held a level right in here. Well, we can take advantage of this implied volatility spike because we know that increases the extrinsic value of an option, not the intrinsic. That means that time value goes up dramatically, right? And so what we would look to do in that situation is we would look to try and put on a bull put credit spread. Okay, we try to get this timing where this has moved down really sharply, spiking that up. The emotions of this trade, the emotions of the market are really high. And we look for that nice solid support level where it looks like, well, let me ask you this. If a stock drops precipitously like this, what do you think the next likely move is going to be? Relatively soon, what's going to happen? People will kind of come to their senses. The panic will drop away, and we'll get some kind of a relief rally or a consolidation. Right? Because when stocks drop like this hard, let's say this is Microsoft. What do you think Warren Buffett's going to do when he sees this occur? Or a big institution? Yeah, they're going to buy. They never had a chance to buy Microsoft this cheap in a long time. They're going to buy it. Okay? So if that begins to happen, if we get that big sell-off like this, then what we look to do is put that bullish put credit spread where we sell one here, buy one here, and the only reason this trade is even possible to give us enough premium to make this trade work is because the implied volatility changed. Okay, that's the only reason, and you've seen us do this here recently. We've done it with the market rally back. We've done it with the market sell-off, that big strong sell-off. We sold bull put credit spreads, and in one day, on a trade, this occurred on a diamonds trade. One day. Because the implied volatility spiked, we can take advantage of that with the right strategy and bring money into our account around those highly volatile events. So there's the volatile events that can be news-based or related that are coming, something that we know of. And then those events that spike the implied volatility because it was an unknown. Everybody gets scared. What just happened here? And we take advantage of that move, knowing that big sharp sell-off is likely going to either rest. What happens to our implied volatility if we consolidate? Implied volatility collapses, shrinks back, right? Drops. That's right. Implied volatility drops even faster if it rallies. Okay, so our credit spread that we placed down here below that support level, we just allow that stock to move away from us. We took advantage of that big spiking move in the market. And, you know, just to kind of demonstrate what we did here, you know, our diamonds were, you know, we kind of moved up and we kind of slid out here sideways. And then all of a sudden we get those news events. And what did we do in the market? We just collapsed. We just dropped like crazy. Well, we took advantage of that, finding a price support in the chart, placing that bull put credit spread on the market. All of a sudden, the market says, oh, wait a minute. Things aren't as bad as we thought, or we've kind of got carried away in the sell-off here, and we spike back up. We spiked up for 2 days, right? That made this thing very profitable. We closed this for a trade. And then what did we do? We looked at our price resistance up here, the fact that we were still underneath our 50-day moving average, and we looked up here and said, let's place a bear call credit spread up here. Taking advantage of that high implied volatility move, the good price pattern in the chart, the resistance of that chart. So here's what somebody said, this is a great time to, IV is high, we just blindly put on iron condors. No, we don't. We study the price action of the chart and place these trades wisely around support and resistance levels to give us better odds. If we just blindly rush into the high implied volatility without thinking of the setup and the structure of the chart, all we've done is taken a higher risk trade. Does that make sense, guys? If we don't plan our trade based around the price action and the structure of the chart, a high implied volatility trade is just a higher risk trade. Okay? So that's what we have to think about. We have to be cognizant of what the pattern is. I have seen high implied volatility options in a lot of places in a chart and have absolutely no interest at all in trading anything in that stock because there's no pattern. There's nothing that I can trade around. But you often don't hear that when people talk about high implied volatility in the structure around trades, because they just say, man, and you guys have heard it hundreds of times. Boy, the best way to make money in the market in options is to be an option seller at high implied volatility. It's like a mantra out there. Boy, the only way to make money is be a net option seller in a high implied volatility environment. That's how you really make money. But if you don't have the chart structure to put that trade together, you're just asking for a beating. And that's the problem. That's why a lot of people that start out with that kind of an idea. Oh, hold on. There we go. Novia kicked my mic out. That's why so many people that start down this road of selling premium, they've never been taught the structure. They've been taught the idea that selling high implied volatility is the key to making money, and it can be. But if you remove that high implied volatility from the structure of the overall chart, just kiss your money goodbye. That's why so many people get beat up doing it, why so many people will tell you after they've done it for a while, spread trading doesn't work. No, spread trading works just fine. But you didn't get the full picture, the full plan to make spread trading work, to take advantage of that implied volatility and what that really means in a trade. Okay, so in this situation, what we did on the markets, and you guys know this, is we've moved back down, making this trade very profitable. Now let me ask you, if we hold this support like we did yesterday, hold this support and bounce back up, do we have a really great opportunity to do this again up here? We might, but it starts to become more and more rare. And the reason I say that, do you guys, when IWM was pushing down through that support that we talked about yesterday, and I was trying to get that 30% credit spread, bull put credit spread on IWM, it never filled. Yeah, that's right, Bob. What happens is there starts to be a diminishing effect in that implied volatility. The panic, the initial shock, that initial emotion that spills out on the market fades. Okay? And so we start getting that diminishing effect in that applied volatility because that fear, that panic, all of those stuff starts to diminish a little bit. And that's why I was telling you guys I would have rather preferred that the SPY just had that flushed all the way down to the 200-day moving average and get this over with. But instead what we got is this bounce back up on Friday that doesn't change anything. It doesn't fix anything. It doesn't resolve anything. So it leads us to more confusion in the market. We have this downtrend in play where this can just fail right back down. That's why I was really hoping that we would just flush this out. Just let's clean up this mess. Let's flush this out. Let's go see that 200-day moving average on the SPY, and then maybe we can get back to some trading here in the market. But that's not what occurred. No, that's not going to make it easy. But let's think about this. When this occurs right in here, this next move down to the 200, if it does occur, that 200 down in here, I'll bet you $1. If that occurs, the implied volatility won't spike near as much as it did over here. It'll give us a diminished ability to take that credit spread. Okay, so when you're thinking about implied volatility and trading around volatility, it's really, really important. And this is where I think people really miss out on implied volatility. They don't focus in on the chart. They don't focus in what that really means for the emotion of the market. IV is showing us emotion, fear, panic in the market. And after some period of time, you get a bunch of whips in the market. What happens to that implied volatility? Over here, it was really quite high. But every subsequent move, that fear and panic dies off. And the reason that occurs is when this is going on, what happens to a lot of traders? A lot of traders will just go to cash and we'll just set this out. So you don't get that combined panic effect. Yeah, Warren Buffett has a saying that you only know who's swimming naked when the tide goes out. He's waiting. He's been waiting for a long time for the tide to go out. For prices to get cheaper. So he can buy good stocks at low prices. So you get a lot of traders setting this out. We start getting that diminishing effect in the implied volatility. The shock value is gone. Does that make sense, guys? So when you're planning around that implied volatility, keep in mind the rights and obligations, what you're doing in your trading. This is extremely important. And I've said this over and over and over in the room. If you understand implied volatility, or if you understand the rights and obligations of an option, you can actually figure out any trade in the market. Okay? And you can think clearly through the implied volatility situation. What is happening? If I have a right and I bought an option with relatively low implied volatility, do I want implied volatility to rise? It's a trick question. If I have the correct direction, I want implied volatility to rise. If I've bought it at the right time and I have direction right, I want that implied volatility to increase. If I didn't have the timing or the direction right and the stock is moving against me, I don't want that implied volatility to increase. Because it's going to be affecting me in a negative way on that trade. Okay? If you have the obligation, if you're the writer of the option, do you want the implied volatility to increase? No, you don't. If you're the writer of the option, you want to be selling it when the implied volatility is high, and then you want the implied volatility to collapse. Because remember, when you sell an option, the premium you collect is the maximum profit you're going to make. So you want that implied volatility to collapse in your favor as the option seller. You want it to come back. So once again, timing of that implied volatility is extremely important, isn't it? Because if we sell an option for $3 and our implied volatility rises, and all of a sudden the option we sold is selling at $4, what happened to our trade? Yeah, we're down. We've lost money. Okay? So think about that when you're thinking about the rights and obligations of a trade. If we're looking at those big spiky moves, if we're looking at, let's just talk about our covered call strategy that we use a lot. If we have that nice trend and the stock moves up and pulls back, and buyers step in, and we buy a long option on this trade, is this the best time to be selling a covered call on it? That's right, no. Let me ask you this, is this the best time to be doing debit spreads? It's a good time to buy the long part, but not the best timing to do the short part, right, of the trade. So if we think about the price action and understand the rights and obligations of the trading that we're doing, we can define our strategies better in our trading. If you want to do the covered position, if you want to do the debit spread, we can actually maximize our profits in this If we're right on direction and our timing and that stock does move up, as that stock moves up, we have the opportunity then to make more money by selling our premium out here after it's moved. Yes. So that IV here increased slightly, but it increased. And now we're expecting it to do what most stocks do, rest or consolidate. And if we time this, we sell this debit spread here. We're long here, then sell your short strike. In the fig leaf trade, we have that longer term option, and then we're selling these short strikes after we get that move in the market. Because this raises the implied volatility, and then the stock rests or pulls back in a nice controlled little resting pullback. This implied volatility drops slightly, giving us the best advantage in this trade and this trade at the same time. Does that make sense why I do what I do? Why I'm always looking to try and maximize my trade? First off, if I do this here, after the trade has moved up, I get it. Let me redraw this. If we're looking at that, if we're looking at that trade, and we buy this in here, if we immediately sell that covered call or that debit spread right here, we're limiting our potential profit in the trade, right? Because oftentimes that 30 delta strike is going to be actually pretty darn close to price. Okay, right in here. So we get that move, and it can work. It can be a positive trade. I'm not saying it's not that you can't make money doing that. What I'm saying is you can maximize the profit if the stock moves up, then sell that out of the money strike. And if the stock continues to move higher, you get a bigger profit. You get called away at a higher price. But if the stock does what it normally does, and it comes up in here and then rests and pulls back and consolidates back toward its trend, we collected a higher premium for this option, got a little bit further out of the money, so we actually get a better hedge in the trade. Now, I didn't figure this out myself, because people just, when they teach these strategies, oh, debit spread, you buy this one, sell this one. Okay, got it. But it wasn't until I really got a firm understanding of the rights and obligations in a trade and how that implied volatility, I can actually maximize or improve my profits by setting up a position. And here's the mistake, okay? How many of you heard this when you listen to somebody talk about debit spreads? That the reason you take the debit spread is to lower the risk of the trade. Right? You take the debit spread to lower your cost in the position. Right? Here's what they don't tell you. If this premium here to buy this long call option is $7 a share and you can't afford $7 a share, should you really be thinking about taking this trade to begin with? No. You're trading outside of your comfort zone. And just because you can sell a premium up here to lower that cost to put you back into your comfort zone, that's not a wise trade. You're compromising yourself in this position. And they never tell you that, do they? They never tell you that you're putting yourself in a situation where you really shouldn't be. So what I always tell people, if you can't afford this position right here to buy that trade, put that stop loss in, then you really shouldn't even be thinking about a debit spread, a credit spread, or anything in that trade. Particularly debits. Credits can still be okay depending on how far out you go and what the volatility is like. Does that make sense, guys? So we want to maximize our profits in these trades. We want to do the best job we can with our trading, bringing in that nice premium at the right time, hedging ourselves carefully in these trades, and that understanding the rights and obligations and the implied volatility can help you so much in doing that. If you remove the emotion and the anxiety of trying to put the trade together and just logically think through the rights and obligations, what that implied volatility means to you in this trade, it becomes a lot easier. Oh yes, there is definitely a benefit to debit spreads, NB. But the debit spread, the best use of the debit spread is to buy that long position here and leg into the debit spread. Let that stock move up. If we're doing the technical analysis, if we trust our technical analysis, let's maximize the trade. Let's let that stock move in our direction, then put on the debit spread. Because the purpose of the debit spread is to hedge the trade, right? It's to hedge your long trade. So let's hedge it at the right time. Let's hedge it when we get more premium up here and get farther away so we can maximize the potential trade to the upside. Okay. Make sense? All right. Well, I hope you guys got something out of that implied volatility discussion and how these trades have been working for us, why they've been working for us so well, because we're taking advantage of that implied volatility at the right time. We're not just blindly rushing in and saying volatility is high, we should be doing wild and crazy things here. And you've seen how it's worked, for Bob S. And several others when I mentioned, this credit spread on Microsoft right in here. And that stock moved back up and away. Nice profit on the trade. How it's worked on so many of those trades because we took advantage of that volatility spike. But now, trust me on this, in Microsoft, you're going to start getting a diminishing effect because that shock value is gone here. Unless we get some new shock in the market, we're going to get a diminishing effect of the implied volatility trade. Doesn't mean that it won't work, that you can't get them, but that effect is going to be diminished on stocks like this. Okay? Well, you can certainly look for them, Alan. If the setup is there, yes, you can certainly look for them. The problem that you're going to have when the bid-ask spreads are wide, it's also widened up on the strike that you buy. And so it's kind of, well, doesn't really help you much, or at all. And then what you're going to find is that they will bring those back together 10 or 15 minutes after the market opens. And so they normalize fairly quickly. And that's one of the reasons why we always tell people, particularly with options trading, is try to avoid that first 15, 20 minutes of the market, because those options haven't normalized their bid ask yet. Okay. Thank you guys. I truly appreciate you guys being here today. Hope you got something out of this. This is a members e-learning. Okay. So this will be loaded over onto, it'll actually be loaded onto YouTube, but the link will only be over there in the, link will only be on the website. Okay. Thank you guys. Appreciate you being here. Have a great weekend. We'll talk to you all bright and early Monday morning. Have a good one, guys.